What are options and why they can 10x your potential profits? Are you tired of watching stocks make huge moves, but your shares barely move your account? Or maybe you've heard of options but thought that sounds complicated and risky. Today, I'm going to break down exactly what options are and why they can give you 3x, 5x, even 10x more profit potential than simply buying shares. If you're new here, my name is Nick, and this is Gen W, where we break down the real strategies behind building generational wealth, one smart decision at a time. Before we jump in, hit that like button, subscribe, and make sure you watch the rest of this Options Trading 101 series, because everything starts right here. Let's dive right in. What is an option? Let's start simple. An option is a contract that gives you the right, but not the obligation, to buy or sell a stock at a certain price, called the strike price, before a certain date, called the expiration. Think of an options contract as a deal that gives you special rights related to a stock without requiring you to buy the stock itself. As the stock moves closer to the strike price you chose, the contract can increase in value and you can sell it for a profit. And unlike owning shares, your maximum loss is the premium you paid. As mentioned, there are three primary components of an option contract: a strike price, an expiration date, and a premium. The strike price is the price you have the right to buy or sell the stock at. Think of this as the lock-in price. So if you bought one contract of the SPY with a strike price of 690, when that option contract expires, regardless of where the actual SPY price is at, $691, $700, or even $720, you would only need to pay $690 per share. Let's say you did buy the $690 call options, and at the time of expiration, the price went to $700. You would then be able to buy 100 shares of the SPY at $690, but they would be worth $700 each, meaning you made $10 profit per share for a total of $1,000. To make that work, you would have to buy the 100 shares, which would be $69,000. Most people don't have that lying around. So how do you make more money without having to have $69,000 in hand? Well, let's dig deeper. The second part of the option contract is the expiration date. Your contract is only valid for a certain amount of time that you select. After that day, the contract disappears worth something or nothing at all. Most options have weekly expirations on Fridays. There are a few stocks that have multiple expiration dates per week, such as the SPY or the QQQ. The closer you get to expiration, the cheaper the contract becomes, but also the riskier it becomes. Because if the stock doesn't move fast enough, time decay will eat into your profits. We will cover that more in the next video, Options 102. The third part of the options contract is the premium. This is the price you pay to buy the option. This is where day traders or options traders make their money if they don't intend to actually buy the 100 shares when the contract expires. The premium is much cheaper than buying the actual shares, but comes with time limits and decays in value. As an example, if you buy an Nvidia call option, that gives you the right to control 100 shares of Nvidia. If this option moves $1, your contract would then gain or lose $100, $1 move times 100 shares. This is why options can amplify returns. This $1 move in the option is determined by something called delta, which we'll cover in video 2. But let's start with the basics. Let's talk about calls versus puts. There are two main types of options. Calls, you think the stock will go up. A call option gives you the right to buy 100 shares at the strike price before expiration. Puts, you think the stock will go down. A put option gives you the right to sell 100 shares at the strike price before expiration. So instead of buying the stock directly, you buy the right to control the stock. There are very advanced strategies we will cover in the future, but when you start trading options, knowing calls means you believe the price will rise and puts means you believe the price will fall is the main focus. Next, we need to understand that options are rights, not obligations. This is a fundamental concept almost everyone misunderstands. When you buy an option, you are buying the right, not the requirement. You can exercise the option, which means you are wanting to buy the underlying 100 shares it represents. This makes sense if the stock price has risen since you bought the calls or fallen since you bought the puts. You can also sell the option. This is what most options or day traders do. If the stock has moved in your favor, then the premium you paid likely has risen, and you can sell the option to capture that growth as profit. Finally, you can choose to let it expire worthless, but you lose the total premium you paid. I don't ever recommend this, as you just give up any money you put in without anything in return. There is no obligation on the options buyer's side to do anything. How you handle your option is up to you, and doing nothing causes it to simply expire worthless. Most beginners think, if I buy a call, I have to buy the shares. Not true. In reality, most options traders never exercise contracts. They buy and sell the contracts themselves for the profit on the premium. When you sell the option, instead of exercising it, you lock in the profit from the premium changes without ever touching the shares. However, someone on the other side is obligated, that's the option seller. But that's advanced, and we won't get into that just yet. Moving on, why does the premium cost what it does? The price of an option isn't random. It's based on how far the strike price is from the current stock price, how much time is left until expiration, how volatile the stock is normally, and finally, supply and demand. This is why two contracts with the same strike price can have very different premiums depending on the date or volatility. Together, these factors determine how expensive or cheap a contract is and why two contracts with the same strike price can have very different costs. Options offer leverage, the heart of why they are so powerful. Because an option is cheaper than buying shares, it gives you control over 100 shares for a fraction of the cost. It also gives you a bigger percentage of upside and ultimately allows for better use of your capital with far less risk. As an example, Nvidia is currently $185. Buying 100 shares would cost you $18,500, whereas buying one options contract right now would cost you $258. If Nvidia goes up $5 per share from $185 to $190, you would make $500 owning the shares. If you buy an options contract, that same $5 gain in the stock price could send your options up by $300 to $600, depending on which contract you selected. This is why options can sometimes return 5 to 10x in profit, especially when the stock moves fast and the contract has good delta. Here is a real-world analogy to make it click. Think of buying a house. Buying shares is like paying full price for the house up front. Buying an option is like putting a small down payment to lock in the right to buy that house later. You control the asset, but you spend way less money up front. And when it's time, you can buy the house at the price you locked in with the small deposit, or you can sell that right to someone else and it's worth more because you locked it in at a lower price. That's why options are so powerful. But options lose value over time. This is the trade-off that makes options risky. Every day, the contract slowly loses a little value. The closer you get to expiration, the faster the loss accelerates. This is called theta decay, and it's why options are not buy and hold instruments, but rather perfect for short-term value generation. We will get into which options to select in the next video, but I never recommend choosing options that expire the same day or even the next day, because time decay becomes extremely aggressive. These are called 0 DTE or 1 DTE contracts, and unless the stock moves fast, you can lose money even if you were right on direction. Something important to know, a contract's value changes constantly. Options change in value constantly, not just because the stock moves, but because time is passing, volatility is changing, and momentum affects how quickly the stock moves. This is why understanding the Greeks is essential in video 2. Options shine when a stock is moving quickly. Breakouts, trend days, big momentum, market volatility, earnings season, news-driven moves are all ways we expect to see the options value grow. Finally, options give you flexibility that shares cannot. With shares, you only profit when the stock rises. With options, you can profit from the stock going up, calls, the stock going down, puts, the stock moving quickly, the stock being volatile, major news or earnings, and even the stock not moving, an advanced strategy. Options open up an entire playbook that shares simply cannot. Here is the best summary for beginners. An options contract is a low-cost agreement that gives you the right to control 100 shares of a stock for a limited amount of time. You can use this contract to potentially earn much higher percentages of return than buying shares directly, but the contract loses value over time and can expire worthless if the stock doesn't move in your favor. In the next video, we're going to break down strike prices, expirations, premium, the Greeks, and what actually moves an options price. Because most beginners pick the wrong contract, and then they blame options instead of understanding the mechanics. So now that you understand what an option really is, you're ready for the next step. How options are priced, what affects them, and how to choose the right contracts. That's video 2 in the Options Trading 101 series, and trust me, it's a game changer. Hit like, subscribe, and drop a comment saying ready for video 2 so I know you're along for the ride. This is Nick with Gen W. Let's build that generational wealth, one smart decision at a time.